Returns, I think that has already happened. I think the funds have already understood that the 20% plus, which they promised years ago, and I'm not sure that the money which was raised, or the equity which was raised in the recent years, in the past 2 or 3 years, was raised with that requirement. When you talk to the big funds, I don't think they promise the 20 plus anymore. But what can they do to get it is the other question. And to come back on what Ralph said before, they have an environment which allows them to go down because the interest rates are so low and the cost of money for them is so much lower than it was some years ago or in the previous cycle that it's probably easier to accept the 15 plus. But what can they do to get it is the other real question. And as far as I heard, you said that we are getting into a seller's market. That comes back to the title of this panel when we say distressed. Are we really talking about distressed is the question, because isn't distressed today assets where we don't have any buyer? Because that exists. I mean, there is a lot of properties, there are sales where in the end the sale doesn't take place and where probably the lender or whoever is forced to sell the loan in the end because they can't find anyone for the asset as soon as there is not. So the question is, yes, a seller's market, but for assets which in my opinion are not distressed really. So isn't that probably a way to find returns higher than that if those opportunistic value-add investors accept to go into assets which are really distressed, where it's very difficult to find a buyer and where the pricing is probably going to be very, very aggressive. Because there are some transactions where you don't even have a pricing. You just have no one in front of you. So probably that's where we can find opportunities in the future. I don't know whether this is the way you would look at something or not, but definitely going up the risk curve. I don't know whether you look at those kinds of assets or...
Yeah, I mean, it was just, as you mentioned it, just thinking about, honestly, we haven't seen, at the end of the day, every asset has its price. So the question is, what is the base of the cash flows? But this is, we're really talking about a very, very small percentage of deals. So I'm not sure whether that really...
I don't know. For example, when you look at the Netherlands, go back to the Netherlands. Today, an office portfolio in the Netherlands, would you touch that? Let's say with an occupancy around 50%.
Yeah, we would touch it.
Because that's not the case of a lot of investors.
Yeah, but
Yeah, so that's where you can find your opportunities. And that's where...
they were like Patron, Univest was basically an office portfolio, and so it all, as well as it all comes down to pricing, I suppose.
Yes, and that's where we are not in the seller's market at all.
Yeah. No, for sure. But this, this, in my opinion, comes across with are the Netherlands really that interesting to invest into? And you will see over the next months now, there will be demand for these things because capital is coming into it. There will be demand with that. So I guess, for sure, I guess this will definitely come. Yeah,
and not a lot of people have been looking at that for the past. So you will always find opportunities ahead of the others, probably, but you have to go up the risk curve. And that's probably what they need to do.
Mount Kellet, Bayside have all done JVs in the Netherlands, and I think their premise is now you can buy in at say 7.5%, whatever it is, and there will be the same movement in capital values, consequential upon capitalists moving around trying to find a home, and their exit at that time. They're not going to wait for the economy to turn itself around. It's a macro play on yield sentiment.